Here at the Canadian Club, we have always been a forum for public figures, thought leaders, and decision makers to share their ideas and inform the most relevant and compelling conversations of our time.
We are dedicated to encouraging debate on the issues that matter to this city, this province, and this country.
The Canadian Club is one of the most important podiums anywhere in the world that a Canadian can speak to, tell Canadians what it is that they think, develop those thoughts. And so I want to thank you for that very, very much.
Please join me in thanking our esteemed panelists today.
Through our programs and events, including our youth and young leaders programs, our diversity partnerships, our joint events, and our media and social media opportunities, we offer you access to dynamic political, social, and business figures from abroad and right here at home.
The platform from which the eloquence of Canada has flowed all of that time, whether it be business, education, politics, sports, arts, and culture. If someone wants to say something to Canadians about this country and about the future of this country, this is the venue you choose.
Good afternoon. I'm glad that you've had a chance to enjoy your lunches and also to get connected or reconnected with some old friends and certainly make some new ones as well. I can certainly feel the energy in the room today. Welcome to the first event of our calendar year, a club tradition that we have proudly co-hosted for 46 seasons and running. 2023 promises to be a complex year for Canada, filled with a myriad of interlocking challenges like high food and fuel prices, war in Europe, the ongoing fight against inflation, political uncertainty in the US, among many, many others. Our event today is more timely than ever, and we are blessed to be in conversation with a masterclass panel that brings context, perspective, and insight. My name is Joseph Lowe, President of Canadian Club Toronto, and I am delighted to serve as your host today. I'm especially appreciative to those of you who are joining us online, thanks to the AV services of Van Valkenburg Communications and LiveMeeting.ca. In the hybrid times that we are, we certainly welcome the opportunity for you to join us and engage with us digitally. And I'm proud to say that there are over 1,000 of you joining us online today. The National Post has been a steady and reliable partner in our annual forecast luncheon. Please accept our thanks for helping to make these events the success that they are. I'd also like to thank Canada's Forest Trust, an ESG company planting smart forests to take action on climate change. This partnership is reducing the carbon footprint of our entire season of Canadian Club Toronto events. We're also appreciative of the generous event sponsorship provided today by Scotiabank and EY. And thank you, of course, to our season sponsor, Canadian Bankers Association, for its continuing support. And I'd also like to make special acknowledgement to the table of young leaders we have joining us today from the Diversity Fellows Program at Civic Action. Please stand and be recognized. We're glad that you're joining us today, and we look forward to having you up at our podium soon. And now, it's my pleasure to introduce to you our speakers. I'm excited to hear what this distinguished panel and their respective crystal balls have to say about 2023. So, joining us today are Kevin Carmichael, Editor-in-Chief, Financial Post. In addition to his role at the Financial Post, Kevin is a Senior Fellow at the Centre for International Governance Innovation. He has been described as one of Canada's leading business journalists, contributing to a number of award-winning stories throughout his distinguished career. We have Dennis Mitchell, Chief Executive Officer and Chief Investment Officer, Starlight Capital. Dennis has served in his current role at Starlight Capital for almost 5 years. With more than 20 years before that of investment experience, he has held at executive positions with firms like Sprott Asset Management, as well as Century Investments. He is also the co-founder and director of the Black Opportunity Fund. Amanda Lang, host, Taking Stock, Bell Media. Amanda is an award-winning business journalist who has covered business in North America for over 25 years. Today, she hosts Taking Stock and was previously host of Bloomberg Markets. And prior to that, Amanda was CBC's senior business correspondent. Jean-François Perrault, Senior Vice President and Chief Economist, Scotiabank. Since 2015, JF has led a team of economists to support Scotiabank's domestic and international business lines. And prior to joining Scotiabank, JF held prominent roles with the federal government, the Bank of Canada, the IMF, and the World Bank. So everyone, clearly we have amassed an incredible concentration of the best minds on the topics of the day. What questions might you have for our panel? Please use the Q&A cards that you'll find at your tables, and we will collect them and certainly get them up to our moderator. And if you're joining us online, you'll see the question button on the right-hand side of your screen. We will be fielding and collecting your questions that way as well. And now, it's my pleasure and delight to turn things over to our moderator, National Post columnist Sabrina Mado. Sabrina is also a frequent on-air commentator and has appeared on CP24, ET Canada, and TVO's The Agenda, among many other broadcasts. Sabrina, over to you.
Thank you. Well, first of all, welcome everyone on stage, in the room, and at home. It is so nice to be here in person for the 46th annual edition of this event. Well, it's safe to say it's been quite a year. Lots of headlines. Russia invaded Ukraine, the Freedom Convoy occupied Ottawa, and a head of lettuce outlasted Liz Truss. Many workers returned to the office, mandatory masking ended, and it became near impossible to get a passport. The federal Conservatives ousted a leader, and they elected a new one. We lost a queen and gained a king. And it became clear that investing in cartoon apes is not such a good idea. We learned inflation was definitely not transitory, and the era of cheap money came to an end. And while it looks like the darkest days of the pandemic are behind us, we're still reeling in many, many ways. Our healthcare systems are strained, labor and supply shortages persist, and political divisions remain deep. So we have a lot to talk about and only about 45 minutes to do it in, so I'm going to dive right in. We're going to be discussing the economy today, housing, crypto, and politics, largely in that order, although they're, of course, all linked. And to begin with, I would like to ask our panelists to, in under 2 minutes, please keep this one short, to describe what you think, what the heck happened last year, and where that leaves the state of the economy today for Canada. JF, let's start with you.
So what the heck happened? Well, a million things by the sounds of it. Listen, you know, I think one thing that's important to keep in mind, despite all the things that have happened over last year, so if we go back to this time last year, so before Ukraine, before rates skyrocketed, before we all worried about mortgage payments and house prices and all these kinds of things, we were forecasting growth of about 3.7 for Canada. And our forecast right now for Canada is 3.6, despite a bunch of things that we didn't think was going to happen, right? And that's one of the lessons I think we've observed from last year is that there is more resilience in Canada than we would have thought. Like, it's been a rough ride, but we're still coming out of it in pretty good shape. And we've been worried about a recession for like 8 or 9 months now. There is going to be one, hopefully. It's a weird thing to say, but hopefully it'll slow down and inflation comes down. So we're looking to that, but you know, there's been this underlying dynamism to Canada that's been really difficult to suppress, despite everything that's been thrown at us.
Amanda, do you agree with that?
I just want to start by saying if economists ever wonder why they're unpopular, that's it. Hopefully there's a recession. I know what you mean. I mean, I think your summary did a good job of painting what last year really felt like, which is a year of contradictions. Because to Jeff's point, you know, we had these external forces buffeting us that we could not possibly have predicted, including the war in Ukraine that continues to be this massive force economically, obviously, socially, morally. But in terms of our economy, we kind of ticked along, right? The labor market has confounded everybody. And this whole notion of the psychological effect of raising rates, I take issue with the word skyrocket because I'm old enough to say they're not even back to normal. But you know, rates went up and people didn't like it. Certainly people who got late into the borrowing game didn't like it especially. But things are pretty good. So it was sort of this sort of strange cauldron of things where there's a lot of bad news, but you still have your job, you amass savings in the pandemic, things are kind of lurching a little bit back to more post-pandemic normal life, whatever that looks like. And so I think a lot of us are sort of waiting for the shoe to drop. When is the really bad news going to come? And maybe it does come this year. Maybe it is a recession that's worse than we fear. But so far, it's been okay.
Dennis, what's your take?
So I'll come at it from a portfolio manager's viewpoint. Last year, costs went up, risk came back, and people were woefully unprepared for either of those things, right? So commodity prices went up, wages went up, interest rates went up. Pretty much the cost of doing business anywhere and everywhere went up. And management teams, prognosticators, portfolio managers, no one was really prepared for any of that. This time last year, we were all talking transitory. We could see through to the end of the year where inflation would roll over, where interest rates would be largely unchanged, and where corporate profits would continue to compound above the long-term 6% average. And none of that came true. And the speed with which all of those things transpired was remarkable, right? I mean, the tightening cycle has been extremely short in terms of duration, if you look at past tightening cycles, and monstrous, in terms of how much rates have gone up in a short period of time. You know, I looked at mortgage rates the other day for the first time in like 3 or 4 months, and 6.5%, which is ironic because when I started at Scotiabank 20 some odd years ago, people couldn't get into the office or the branch fast enough when I told them they could renew their mortgage at 6.5%. So for me, in my tiny pocket of the universe, that is what 22 was about. It was just about costs going up, it was about risk returning to markets, and the fact that people were just unprepared for all of that to happen in such a short period of time compared to what we had become accustomed to for 20 some odd years after the financial crisis. And equity markets down, take your pick, 10 to 30% is the end result of that.
Kevin, your thoughts?
My thoughts. So my thought on what happened in 2023 is, well, history happened. And I remember writing something fairly early in all of this, and I forget amid which particular chaos, whether it was war in Europe or the trucker convoy. But I just looked at everyone in power, and they were all Gen Xers like me. Well, my generation grew up thinking history was over, everything was sorted, war was over, China was going to join us and create one big happy trading family. Probably that was always naive, but we pushed forward. We're optimistic as human beings. We thought we'd just keep pushing, and then everybody was going to come together in the name of their own self-interest. Well, it turns out people define their self-interest differently than perhaps we do here in Canada or in North America. So you know what, if we hadn't decided collectively that everything was sorted, maybe we could have seen some of these things coming. Populism certainly isn't new, we've seen that forever. War in Europe certainly isn't new, we've seen that before. I suppose lots of people they're saying that, we can't trust Russia, we can't trust Putin. But we said, he's awful, but he's not really going to invade Ukraine, come on. Even though he'd invaded Georgia, he's messing around with everybody. He in fact invaded Ukraine. That's just wanted the playground back. Don't worry about it. Well, turns out stuff is real, right? So I think, so that's the world we're in now. We have to reset and learn a lot from what's happened before. I'm not one of those who think that, history, that you can look back at history and then use that to predict what's going to happen next, but it's a decent guide, right? And that probably should be our starting point. So I think we just, what happened in 2023 then is a slap in the face, and 2022 is a slap in the face, and 2023 I think needs to be a reset and recognize that we didn't have things sorted, and so there's a lot of rethinking, a lot of recalibrating to do.
Some great insights there. I want to talk about the most recent jobs report. Canada added more than 100,000 new jobs in December, and the government's estimate had been just 5,000. So it's safe to say the estimate was just a little bit off. The employment rate fell from 5.1% to 5%, and now BOC Governor Tiff Macklem has been clear he considers such a low rate to be inflationary. So what does this mean in terms of interest rates? Are we going to see them continue to go up this year, and for how long? JF?
You want me to start with that?
Yes.
Listen, so, I mean, it's a toss. There's a meeting in a couple of weeks. It's a toss-up whether they go 25 basis points or not. We're in the camp right now where they don't. In large part because, you know, the governor, the last decision he had, basically signaled that he was going to pause. He was going to see how the 400 basis points of tightening that they've done so far was going to filter through. And that was in a context where inflation prints had kind of come in on the softer side, so the story was sort of working out. Anticipated a slowing, we're anticipating a slowing still, but then you get this employment report, which is just completely off the charts, like incredibly strong results, which of course is a good thing in a lot of ways. It means the economy's stronger. But in a world where you need a bit of a slowdown in economic activity to ensure that the decline in inflation is sustainable, that's not really a good thing. So at the margin, this report suggests that the Bank of Canada might go next week, a couple of weeks. Big thing is we have inflation in next week, which will be, you know, a very, very important kind of, actually the ultimate determinant, I think, of whether they move or not. So we're still confident that they don't move, but, you know, the economy, as I said, it's just kind of hanging in there in a way that we just simply underestimated. And same with the Bank of Canada. So he might have thought he was done, maybe he's not, because we're resilient.
Amanda, where do you see that next inflation report coming in? Do you think we're going to see a continued slowing, or are we going to spike back up?
I can't possibly answer that. I mean, if I were going to guess today, I'd say probably like level, maybe slightly lower. I don't expect any big shock, but hopefully trending slightly lower. The number in the labor force survey, which when they surprise us, everybody likes to say is terribly volatile and gets revised and is unreliable. But yet when that doesn't surprise us, we just report it. But the number that really stuck to me was the wage gains. Running above 5% still is just a shocking number in this country. We haven't seen it for now we've stayed there, right, for 7 consecutive months. So that, I think, gets the attention of central bankers, because that's where you get into that, I hate to use the word spiral because it's a term of art, but you start to entrench price gains when you see those numbers.
Mm-hmm. Now, Kevin, you frequently interview Tiff Macklem. What's your sense? Do you have an idea of where he's headed, how he'll react to these sorts of numbers?
I don't, so no, I have no idea where he's headed. I wouldn't want to pretend otherwise. I think something that if you're trying to make your own assessment of where he might be headed, I think you should think about, you know, sort of what the central banks have gone through over the last couple of years. I mean, they've been kind of beaten up pretty badly. I think they started, so back up one step. Central bankers are risk averse. JF knows that well. He grew up in the institution to a certain extent. So they don't like to experiment sort of in real time. But I think in the years ahead of the pandemic, getting back to my point about how things have just been so smooth for so long, I think you started to see the central banks started to play a bit with what they thought they understood about the economy. So you saw them push forward on, especially around jobs, for example. They thought, you know what, maybe we can push the unemployment rate a little lower than we thought and not get in trouble. It kind of looked like it was working for a while. And maybe it was, maybe it would have worked if history didn't happen, like I said earlier. So anyway, so now they're embarrassed. Now they've had their fingers burnt. So I think they're, to a certain extent, reverting back to what they know, and what this group of central bankers know is the U.S. Fed and Paul Volcker from the 80s, and Volcker overdid it to ensure that inflation was good and gone. So I think unless the numbers start to break in a convincing fashion, I think not just the Bank of Canada, but the Fed and the ECB and all the major central banks will be inclined to err on the side of crushing inflation. Whereas before the pandemic, I think there had become a psychology of perhaps erring on the side of growth. Now I think they're going back to what they know, which is beating inflation. So I guess if there was a risk, to use central banking jargon, the risk is that rates will go higher yet.
Dennis, how big do you think the risk is that the BOC overshoots on inflation and sparks a more severe recession?
Great question. I would say it's certainly a material risk because the world is kind of compressed into a really simple equation. Inflation is way too high, unemployment is way too low, and the tool I have is to hike the policy rate. So if that's the sum total of the equation, then the next step would be, theoretically, let's continue to hike. until we get the response from the economy that we want to see. Now, the challenge there is that, there's well-documented and analyzed lags in the impact of rising interest rates and their impact on the economy. So it's a material risk. I don't know if it's 50-50 or what have you. But I will say that if we do have a recession later this year or early 2024, it will be the most forecast, the most, anybody in the room here not think we might be in a recession now or later this year or into next year? Anybody who doesn't think that? Okay, so we have one and a half. I think you were just scratching your nose, right? Yeah. So, one person in here who doesn't think we're going to have a recession. So that by itself probably tells you you're not going to. So this is a tough job, man. Like, this is a tough job. No, I have no idea why anyone would want to be a central banker anywhere, right? Like, does anyone have a poster of a central banker on their wall when they were a teenager? Like, it's a tough job. It's not glamorous. And at this time, it is just crazy. Like, I can't explain the jobs market. I was asking JF about it before we came up here. It makes no sense whatsoever. So, good luck to Tiff. I wish him well.
Don't we all? JF, so is a soft landing possible? Let's say we agree recession's inevitable. How bad is it likely to get?
Well, we're in the soft landing camp, which is, admittedly from a historical perspective, not extremely likely. But we have a set of developments which, actually, I might contradict Kevin here, which I'm going to say are kind of historical in nature, but we have, when you think about the triggers for a big adjustment, obviously interest rates are a big part of that. But then you've got to look at things like balance sheets. Are balance sheets strong or weak? Are they going to amplify their rate cycle? You look at the labor market. Are firms more likely to shed labor? Which, of course, there was this recession, they tend to do that. We know from the labor market now, which is a lagging indicator, the firms are certainly not in labor shedding mode. In fact, one of the considerations about the employment report is, if firms are, if in fact only one person in this room believes there's going to be a recession, isn't going to be so. Yeah, so like whatever, 99.9% of the people in this room believe there's going to be a recession. You would think that firms would look forward and say, well, actually, we're not going to hire now because there's going to be a recession in like 3 months. But they're not doing that. So you put it all together. Balance sheets still actually quite robust from a firm and a household perspective. The odds of a soft landing to us are pretty good given those things. Now, again, I know historically these things don't happen. But the set of circumstances that we're dealing with now are really quite exceptional from a historical perspective. And if it's going to happen, it feels like this would be when it happens. In fact, incoming data are effectively putting a little bit of a question as to whether or not there's going to be a recession, as opposed to, is it going to be a soft landing or a hard one? We're not seeing evidence, and we would hope to see evidence. Let me say that. Expected to see evidence of a pretty significant slowdown at this point already, and it's just not. We're hanging in there.
You're saying the one person might just be right.
They might just be right. Yeah.
Okay.
Or 1.5 persons.
Or 1.5 persons. Related on the labor file, we're undergoing historically changing demographics. For the first time in history, retirements are outpacing growth in the working age population. Does this cushion the job market in the case of a recession? And does it also mean labor shortages are here to stay? Amanda, what do you think?
I mean, the demographic story, of course, is this sleeper hit that we've known about for decades. It was always coming. And it's been interesting to watch it play out through pandemic because it got our attention because during the actual lockdown period of the pandemic, retirements were delayed. So we got this big kind of camel hump bubble of retirements right after that really shocked us. It was always happening, it continues to happen, and it's a big risk to the economy. Does 500,000 immigrants a year of the right age group offset that? I think that's the hope, that's the aim. But it is and by the way, not just them leaving the labor force, but the shift in how they consume is also the other big slow-moving story for our economy that is hugely relevant in the years ahead that probably people who are investing have to think more about than most of us. But those slow-moving factors are definitely alive and well, and those will have huge impacts on central bank policy, fiscal policy for the next decades. And it's a bit of an experiment. The immigration piece of it's still a bit of an experiment because it takes time to integrate a new Canadian and get them into the labor force, and that there's costs associated with that integration. So how that washes out, it's a bit of a, I don't know how long, I don't, maybe Jeff has a better answer, but it's a multi-year experiment.
Well, JF, what is your answer to that?
I don't know if I have an answer to that, but what I do think though, so one of the reasons we kind of square the circle in terms of all the bad stuff that's happened and the strength of the economy that we've seen so far is that population growth has been exploding, right? So this year population growth, last year, say fourth quarter, we saw the strongest population growth on a year-over-year basis since we've seen like 50 years. And before that, before the pandemic, we were experiencing the strongest population growth we'd seen in a number of years as well. And I think we're still struggling with understanding what that means from a macro perspective. Clearly, these are people that are coming in filling jobs. They're buying homes, they're buying all kinds of stuff. It's a very powerful source of growth and support for the economy. And of course, it's going to be long lasting. There's all kinds of policy questions as to whether we're doing it the right way and are we integrating them well or not, and whether it's being done well. And I have lots of views on that. But you know, fundamentally, from a dynamic perspective, again, when you think about the recession, when you think about the year to come, if we continue to experience population growth at the rate that we have seen, like that's a very, very powerful support that, you know, it's not monetary policy, it's not fiscal policy, it's just people living and buying things.
Dennis, do you think that big immigration numbers can offset this demographic time bomb?
Well, I mean, the short answer is yes. I mean, if you increase the target to 1 million people a year, then presto, you've offset it, right? So it's a question, though, do we have the infrastructure and do we have the right meritocratic system in order to maximize that impact or balance that equation, if you will? I will say one thing. Nobody can walk here, okay? And that sounds flippant, but if you look at the US and their southern border, you can walk from South America to Texas or Arizona or California if you want, right? So they really do not have control over their own immigration policy. And that will be a challenge that they struggle with forever, unless they're gonna take a big chunk of their budget and drop it in Central and South America and try to fix those countries the way they fixed Afghanistan or Iraq. They are always going to have this problem. No one can walk here. So roughly 60% of our immigration every year is targeted economic immigration, where we're looking for people with skills to address shortages in our labor market. So I would already say that our system is superior to the challenge that the United States enjoys, or the UK or France or Germany, just out of dumb luck, you know, the way the continent separated, you know, millions and millions of years ago. So I think that there's a viable opportunity and a chance that we can sort of balance that equation. We'll just see what Trudeau and Poilievre and their successors have in store for us on that front. But I'm bullish Canada.
Great. And applause for that. Applause for Canada. Kevin, so the immigration target is 500,000 new permanent residents per year by 2025, and that's not including temporary foreign workers or international students, which are also growing up at record rates. How do you think that squares with some of the challenges we're seeing, whether it's in the housing market or healthcare supply? Do those numbers make sense? Are they sustainable for us?
Well, so are they sustainable? They could be, if we want them to be, if we choose to create the capacity to bring those people into the country. But that's the crux, right? That's the issue. My answer to the question just put to Dennis might be that no, we can't assume that wide open immigration is going to be an answer, because everything I've read on this, and if you look around, everything you see is that there are political limits to how much immigration societies are willing to take. We've been shielded from that political backlash in Canada to a great extent for the reasons that Dennis put on the table, is that we don't have to deal with the issues that they have to deal with in Europe, and we don't have to deal with the issues that they have to deal with in the US, where you just have sort of almost, I don't want to say unfettered, that's exaggerates the case, but you do have this constant flow of refugees migrating into your country, disrupting local communities, and there's always going to be a local backlash to that. I think perhaps the federal government has now opened the doors enough that we're going to see some of that in Canada. We've kind of, I think we've reached a tipping point where our systems, whether it's the health system, housing, isn't up to receiving all those people. So you're going to start to make people angry, right? They're going to have a harder time getting their kids into a house, or they're going to have longer waits at the hospital and see all these unfamiliar faces in front of them in line. Those sorts of things are going to start to come into play. But of course, we could do something about all of this. We could stop messing around on housing and actually build some. And this gets back to my idea about like actually starting to look back at history and what we've done when we've had these problems before. So I think, JF, your benchmark was there's the biggest population surge since 50 years. Well, what were we doing 50 years ago? We had soldiers coming back from the war. We created CMHC. We built lots of houses for them to live in. We can do that now, but we won't. So I think one thing we've learned about the current societies in which we live is it takes crises to actually get the political system, the political class in a headspace where it's actually going to feels compelled to act. So maybe this pressure that we're starting to see is going to force people to actually make some tough decisions, which they haven't made for a decade and a half. So we've been talking about this for since the financial crisis. It's crystal clear what zero interest rates were going to do. It was fun for a while. Everybody watched their housing wealth go through the roof, even while thinking that, yeah, it's going to be tough for the kids to get a house like we got, et cetera, et cetera. We've written thousands of words about this in the Financial Post because people love to read it. But I think, we ignored it for a while, but there's no ignoring it now. So maybe, we will insist that the policymakers finally do something about this.
I think you're right. Where we are now was not unpredictable by any means. I'm going to dive into an audience question here. An article in today's National Post, thank you to whoever's reading the National Post.
You're taking that one.
Describes the amount of debt the provinces and federal government have accumulated. Apparently, over the last 15 years, the federal debt has increased by 85%. Can Canada afford universal dental care and/or pharmacare in light of this? Amanda, what do you think?
What do I think about the lack of fiscal prudence at every level of government in our country?
That says it all right there.
I mean, I think it's a drug we're all enjoying. I think we're all hooked, and those of us who are old enough to remember and actually paid attention to day by day and painful inch by painful inch when the Chrétien-Martin government got our books in order. The provinces can tell you their own stories about how that felt and how hard it was and how long that pain lasted. For years I've been saying, what is going on here? Balance is balance for a reason, and a deficit is, that should be an urgent political issue unless it's a time of crisis. And we've now come to this place where deficits become meaningless. We just pass the debt on to the next generation, quite literally. I don't see that changing in the near term, because instead what we're going to be faced with is actually an economic reason for governments to spend. We're going to see easy policy out of our, hopefully not in the spring budget, but possibly that soon, a government that says, well, we need to support Canadians because of affordability and because of the recession, and those are all valid arguments, and they work politically, but we've strayed a long way from the idea that we will send you a certain number of tax dollars and you will spend it the way we've decided you're going to spend it. And that should be a zero-sum game. And you can be overly dogmatic about that, but I wish we got a little bit more on point.
JF, I have an audience question for you. Do inflation-indexed increases to commodities like alcohol fuel higher inflation, or are they neutral?
Well, so they fuel higher inflation. I think the question from a policymaking perspective is how you look through those things. And generally speaking, they should be looking through those things. The reality is that indirect taxes, indexation, all kinds of things feed into our frank reflection of how people think about inflation going forward. So to the extent that, for instance, that wage settlements reflect anticipated inflation of something other than 2, which is increasingly the case, because it should be, that comes back and makes inflation control even more difficult. That's partly why the governor spends all this time talking about 2% inflation. We're going to get everything back down, because he wants people to believe that's going to happen, because if they believe it's going to happen, then you don't have some of this indexation going on that actually makes his life, their life, much more difficult than otherwise would be. So it's real, and it has an impact, for sure.
Yeah. Do you believe Tiff when he says that?
No. And I don't think, that's not our forecast. He has no, I'm assuming that he believes it when he says it, but he's got no choice, right? When you're trying to convince people that, his job, 2% inflation, that's the law. He's got to convince people that that's going to happen, because if he doesn't convince people that's going to happen, his job becomes so much more difficult. So there's an element of, and he would never, ever, ever, I'm sure, agree with anybody suggesting that he's misleading folks. But I think a little bit of misdirection is helpful in this context. You've got to, whatever you can do that makes people believe you're going to do your job or achieve your objective is helpful in the current circumstance. The risk is that you say it for so long that people start displaying it's the Peter and the wolf. Peter, the boy who cried wolf. Sorry, that's the French version of it. That you keep saying it and it doesn't happen, and ultimately undermines your credibility. And in fact, that's I think one of the challenges that we've been dealing with here. That he's been saying this for a while, and there has been a loss of credibility. It's undeniable, and rates are probably needing to go higher. They're probably higher now than they would have been otherwise, had he, I think, maybe been a little bit more humble and been a little bit more forthright in terms of his understanding of inflation and what that means for Canadians and policymakers. But we are where we are, and we're dealing with it, or he's dealing with it. Or we're
all
dealing with his actions
it together. Kevin, what are your thoughts on that? Do you think Macklem's serious about bringing inflation down to 2%? I know he told you he was, but do you believe him?
Well, I'll pass on whether I believe him or not. I mean, I echo what JF said. I mean, he's not, he believes it. He has to, right? The same way I believe that people are going to keep reading newspapers for the next 2 years. Tiff Macklem believes that if he does what he needs to do, inflation is going to get back to 2%. Does that mean that inflation is going to get back to 2% because of all these things that are going on in the world? Maybe not. Are people going to keep reading? Are people going to be reading newspapers 2 years from now? Well, I hope so, but maybe not. Maybe everybody's on TikTok in 2 years and they don't care what I have to say every day.
Pretend I never heard that.
So yeah, I mean, like, it's based on everything that Tiff Macklem knows about the way economies work. He thinks that he's I think weighed the evidence and decided, I can still get back there, and you know what? Maybe I need to get back there because things just kind of work well at 2%, which is roughly a paraphrase of how he framed it to me when I talked to him before the holidays. So, so the way he sees the world now, I think that's where he wants to get, which is why if I was, so unless inflation does break, and it might break, we've seen in the US and Europe, the inflation kind of seems to take a real steep dive. So if we saw some numbers like that, I think the Bank of Canada would probably back off. But if they stay kind of mixed like we've seen, being fueled by those big job numbers that we're talking about, I think probably the Bank of Canada will keep raising interest rates for this very reason, because, if for no other reason, because as JF put it, because of the law, his job is to get back to 2%. So until Pierre Poilievre is elected and fires the governor, I mean, I guess that's where we're headed.
Can I just maybe add quickly on that? So, I mean, we do think inflation is going to go back to 2% at some point. I think anybody who looks at inflation these days and is very, how to put this, very certain of their views is being a little bit delusional. The reality is there's all kinds of stuff going on with inflation. It's shaken understanding how things work, and to extrapolate from that it's going to be, I'm 100% certain I'm going to hit my objective at some point in time, given the changes that we've experienced. It's a bit of a risky play, but he's got to do it. And again, we think inflation will be 2% at some point, and he'll do what it takes to get there, because he can.
Yeah, and then the JF and Kevin show now. And I think, and the question you asked about demographics is very much part of this whole conversation. Now, based on what we know today, there's no reason to think that the central banks will not continue to push to 2% or whatever their targets happen to be. But they're aware of all the things we're talking about. They have far more computing power at play trying to figure out what's going on. So they'll adjust as they go along. But You know, to the point that JF's been making today, the central banks can't say, yeah, no, maybe we'll let up and not get back to 2%. But if facts change 6 months from now, 9 months from now, you know, maybe Tiff Macklem's and Jay Powell's rhetoric changes somewhat too.
And if I may, this is we were talking earlier about how we wish we could stop talking about central bankers. It's so boring, and it's the same conversation. And for most of us, though, the way this plays out is, and it's got to be, we're also agreeing that we're so happy that for us, some of us, this is a theoretical, interesting, you know, curiosity. Some people have to actually invest, make hard decisions, invest other people's money, and the equations at play here are. And got hats off to you. But have we seen a semi-permanent, like a multi-decade or even generational shift away from low for long, away from low easy rates, easy money, back to what we might call more normal, or even go further back beyond that to something that's a little bit more like 4 or 5% for a longer period of time? And that's an equation that everybody actually needs to get their heads around, because most people are hoping that 2022 was a blip for stocks, for, you know, that we'll just get right back to our trajectory of everything. We might not. There is some scenario, and very smart people are out there trying to figure out, is this a pivot that we actually are going to have to live through? We don't get back to 2%, we stay at this higher level, and we rethink risk and return in a way that is persistent. That's, to me, the big question for 2023 and beyond is this with us? And now we have to rethink our expectations. Do we buy GICs again? Maybe that's where we are. But he knows.
Dennis is shaking his head. Why is that?
No GICs?
No.
Because trading GICs is boring. That's why.
Puts Dennis out of work.
Yeah.
That's what it does. I think Amanda's probably right in that we've enjoyed, since the financial crisis, this prolonged period of exceptionally low interest rates, very low inflation, very strong growth, and you know, you could launch any kind of business and make money. And now we're starting to reap some of the negative of that period of time, right? So whether it's FTX, whether it's crazy things like TikTok, whether it's the challenges we had with bridging finance in this country, you're starting to see the downside of having really low interest rates, free money, and unfettered ability to capitalize businesses of almost any kind. So I do think we're probably in for the next 10 or 12 or 15 or 20 years being slightly different from the last 14. I do think interest rates will probably be higher than they were for the last 15 years. I don't know what that level is. You know, guys like JF get paid a lot to tell me. And I do think that business will become much more difficult. And so I think that, you know, my job is going to become much more difficult going forward. Well, relatively so. I manage real estate and infrastructure, so they don't change all that dramatically in over short periods of time. But I think it will be interesting. And I think people like myself are going to earn their keep over the next several years, and we're going to lose our jobs.
Well, you mentioned real estate, and that's something I want to touch on. There's a few questions in here about housing. It's no secret. Prices are insane. They remain insane. I should know. I'm a millennial. I still rent. Dennis, am I ever going to be able to afford a home? Where's the housing market headed?
Wow, no pressure. So as the father of several millennials, I really hope so. But I would say yes. And one of the reasons I would say yes is because innovation. I had a fantastic conversation with a woman earlier this week. Her name's Amy Ding. Her company's Requity Capital. So all of you should have a look. But they are creating, well, it's not really a new concept. It's rent to own, right? Those types of business models. I've read newspaper articles about co-living, right? Two people who have nothing in common other than they both want to own a home, and they think they're compatible, and so they both buy a home together. I live upstairs, you live downstairs, and we sort out the utilities and all that between us. You know, laneway homes, right? So innovation in the housing market will make it possible. Now, do I think we're bifurcating into haves and have-nots? Yes. I also think the sun will rise in the east and set in the west today, right? That is just the natural course of civilization across however many years you want to look. Okay, So I do think that it will be a challenge, and that people who are born today are born into a fantastic world that is better than the world that I was born into, but it doesn't mean that it doesn't come with challenges. And home ownership and the ownership of assets and production will be more and more difficult for the average person to achieve. So you are going to have to save more, sacrifice more, or become more creative in your pursuit of home ownership. But I'll flip that around a little bit and say, if you can't own a home, does your life change dramatically? The money that, well, assuming that renting is cheaper than owning, and that's debatable in some places, but assuming that renting is cheaper than owning, what you do with the surplus should define your standard of living going forward. So I can think of 12 different products that you should invest in that'll help you with that surplus to enjoy a better standard of living. Right?
Can I
Amanda,
jump in?
yeah, looks like you have a
dying
thought.
to get it. The problem that we have, I believe, in housing is, yes, it's supply and demand, and to Kevin's point, it's a decades and decades slow-moving problem. We're all aware. Why don't we just build more homes? The problem is we have financialized our housing system. We've turned it into a capital markets asset, and the solution may be more financialization and capital markets products around housing, or this is in our control. This is why I think we shouldn't stop talking about this. We take it back. We remove the concept that your home is going to be your best investment, and we go back to what it was historically, which was a store of value. You made money, but you basically kept up with inflation over the lifespan of your home. So when you needed to cash out of it, there was the money. It felt like a lot because we all lose track of the growth power of inflation. But we get rid of this idea that we're going to make a killing on homes and that some people will make more than others and it's an asset to trade. It's bad for us, but it's good for all of the participants in the market, and there are many, right? This is the biggest sector of our economy now when you add them all up, and it's good for everyone who's already in the game. So the dirty part of this problem is none of us want to change it. We're in it. So let someone else. Now, what might fix it? A strong mayor might fix it. Somebody who's not running for a fourth term might fix it because they don't have political capital to lose. But the politics of housing is the problem. It's a third rail. It is not a financial problem. It's not a supply and demand problem. It's a decision that was made for all of us. We got to take it back or stop whining. And yes, you'll rent forever. Because, or if you're lucky, somebody who loves you will give you money or die, and we'll see an intergenerational wealth trend.
It got a little bit dark,
and you got a problem with me being hopeful.
Right? He wants a recession. I want people dead.
Didn't see the panel heading in that direction.
But we should stop talking about like this is an economic problem. This is a social problem. It's a policy problem. It's in our control.
Yeah.
Can I'm going to challenge that a little bit, because the only reason that you have investors in the housing market is because you've had a supply-demand imbalance that has created abnormal returns in the housing market.
I'm not talking about investors. I'm not talking about people who buy a home for the pure purpose of investing. I'm talking about turning every homeowner into an investor, so that all of us now have a mentality that the place where we shelter, which is a basic human right, and we want it for everybody, and it does matter if you rent or buy because we don't have good rental stock. So if you want a nice place and you want more than 2 people living in it, you probably need what we would call a house, some kind of a home. We've turned ordinary homeowners who just need shelter into investors. And that's, to me, that's the distinction I would make.
Yeah, I come back to, I think that mindset is manifest because we haven't had enough supply. So people, their experience has been, if I buy a home, I am going to make on average 8, 9, 10% a year. And so I need to buy a home, I need to enjoy these returns, and then I can keep trading up. And I think that is purely a function of not enough supply.
Is it overly cynical, though, to say that we've had constrained supply because there are too many participants who benefit from that? It's a supply and demand market. If you're a politician who says build 10 million homes, you've just tanked the value of all of your constituents' property. Are they happy? No.
Excellent point. But I would say the demand in this side of the equation is literally human beings, right? So to your death comment, as long as we're going to continue to have children and as long as we're going to continue to allow people to immigrate to this country, you're going to have increased demand. Policy certainly plays a role, right? I mean, immigration policy is we went from 250 a year to 450, and theoretically we could go to 5. right? We're creating the first-time homebuyers savings account. What does that do? It pulls demand forward, because people who were saving X amount per year now have the ability to save X plus per year, which means that demand gets pulled forward. So at the end of the day, this country the population is going to grow. Even if we shut the borders, people are going to have babies. I would think I've got 4 of them, right? So I've done heavy lifting for some of you out there, right? So population is going to grow. The demand for residential housing is going to increase. And the question becomes, are you going to create enough supply to keep that market in equilibrium? If you don't, then you're going to have the continued investment gains that encourage more investment and risk-taking in the housing market. If you do, then people like myself will lose interest in investing in the financial side of residential housing, and we'll find other places to put our money to generate abnormal returns, right? Industrial real estate instead of residential.
Well, I hate to cut into this heated debate. Clearly, we could talk about this all afternoon, but we are almost at time. So I'm going to have to wrap this up and ask you all for one last word, a one-sentence prediction for what we will see in 2023. Kevin, what's yours?
I was hoping that you were going to start with JF. I get 30 seconds to think about it. Look, I think it's one word. I'm about to give you 50. I still might give you 50. I think it's not going to be as bad when we're here next year as it feels like it's going to be right now. I think there are too many important technological forces, meta forces at play that are going to create all kinds of opportunities for people to take risk and push society and economies forward. There's going to be some pain along the way. We're going to see some of that like right in front of us. That's what's happening right now. That's what we're seeing right now. But at the same time, there's going to be all kinds of amazing things happening. So, I think the amazing might, in fact, outweigh the ugly.
Great. Dennis, your brief prediction.
Bifurcation. I think that next year at this time, and we're going to differ a little bit, I think fundamentally things are going to be worse, because you will have the impact of raising rates, the impact of commodity prices having gone up, the impact of short-term surplus, short-term, the opposite of surplus, deficits, impact the economy. And you're already starting to see companies lay people off. You're starting to see them cut earnings forecasts. So I think fundamentally things are going to look worse. And perversely, I think equity markets are actually going to be better, because they are forward-looking and they will say, we are at the nadir, and now things can only get better from here. And really hope that's true, but I think we will see bifurcation. The economic data will be weaker and worse, but equities will actually start to perform better.
Okay, Amanda, quick prediction.
I would say 2023 should be about keeping your circle of worry inside your circle of control. Lots of stuff is going to happen. It's all going to be exogenous, as these guys like to say. If you have a job, if your family's okay, if your house is good, focus on that and keep doing what you're doing. And in Canada, that's a lot of really good, healthy companies, people with good jobs. I think we've got a lot that's going well. We should focus on that.
Okay. JF, close us out.
Well, I was going to say something similar. Worry less about the short run. Things are going to slow, they have to. But think about some of the positives as you think about Canada over like 2, 3, 4 year period of time, where the demographic factor, which we talked about at length, really is a huge differentiator for us, right? We're going to have population growth at a time where Europe is going to have population declines, where our population will grow more rapidly than the US. There's a global shortage of talent right now. Like the opportunities that are available to us, if you think a little bit longer term, if you don't worry so much about the next few quarters, I think have there really is the makings of whatever you want to call it, the Canada decade or something quite spectacular if the stars align in a way that they should or could.
Something quite spectacular. I like the sounds of that. It's a good note to end on. Let's get a round of applause for our panelists.
Kevin, Dennis, Amanda, JF, thanks for your masterful engagement on these pretty complex topics today. A couple of takeaways that I certainly counted. Past this prologue, balance and moderation should not be underrated. And I think the note of optimism is that Canada is uniquely positioned to weather we're about to go through, and we're just going to keep chugging along as we do. So certainly I wish you all great success in the year ahead, and we look forward to certainly taking a look at what happens kind of with respect to the predictions we talked about on inflation next year as well. Sabrina, thanks for your masterful moderating of a very dynamic and obviously complex discussion today. Members and guests, I hope that you'll join us for some of our upcoming events as well. On Wednesday, January 25th, we host a dynamic panel of experts to address one of the sectors we talked about today, in fact, tech fundraising and the scaling in today's environment and the implications for entrepreneurs. The following day, Thursday the 26th, we'll host a virtual panel on DEI practices, what's working now, and what do we still need to learn from and lean in on to take it into the future. And on the evening of February 1st, the Canadian Club will host its 125th anniversary celebration. I hope that you all take the opportunity to join us for an evening of conversation and cocktails, featuring an impressive panel of former premiers, including the Honourable Christy Clark, the Honourable Jason Kenney, and the Honourable Kathleen Wynne, moderated by TVO's Steve Paikin. I hope that you will all find the time to join us. Members and guests, thank you once again for joining us for our first event of the calendar year. I look forward to seeing all of you again soon.